Well, thanks so much for tuning in to Talking Point. I'm your host, Neeraj Shah, and it's a complex world out there, at least because of the fact that we have multiple other events which distract us, noticeably the Euro Cup 2021, which I'll talk to Ajay Srivastava about, but also because of the way the pulls and pressures on individual spaces as well as the market at large seems to now be coming to the surface. And to talk about all of this, Ajay Srivastava joins in. He needs an introduction, really. Ajay, great having you. Thanks so much for joining in.
Good
Lack
morning.
of sleep today?
Well, well, it was a wonderfully short sleep, but it's going to continue for the whole week. We got Wimbledon, we got Euros, and luckily the stock market is not doing anything funny. So you are at peace as to what you made is being protected. Nothing much is being lost. So I think it's a good time for all the sports event when the market is going to do slumber.
Yeah, that's true. Actually, this morning I also caught up on Argentina versus Colombia, and even Argentina won in a penalty shootout. So that was pretty interesting. But yeah, so Ajay, let's talk about why do you believe that, and then I'd love to talk a lot more about specifics. But just wondering, I mean, for the sake of it, I'm asking you: is it even possible for you right now to take a directional call on the market?
See, the directional call is very clear. Is that you got to be fully or mostly invested in the market. When I say mostly, means because everybody has a few stocks which you thought you should have bought, but you did not buy. And this market is giving you wonderful opportunity. Doesn't matter what stock it is, you get a chance to buy it back. So that's why I say mostly invested. And the reason are very simple at the end of the day. One is that the government policy at the end of the day is straight away favoring the corporate in India, and which is positive for the market. We may debate the philosophical element of it, but practically the policy which said that I will tax more at the lowest level, which is the petroleum tax and so on, but still reduce the corporate tax, gives you only one signal that you got to be invested in the corporate India, because that is where the money is going to be made at the end of the day. So we are men of money and the market. So we say if government policy says favor the large sector, we need to be invested there. So that's the positive side of it. Sometimes you get pangs of what's happening to disparity of income, etc. But this is not the forum for that. So directionally, very clear, it's a positive call, and we are seeing more and more participation of people in the markets. We are seeing, most important thing, we are seeing politicians out of surprise coming up with amazing policies like the excise policy of Delhi. Now, who thought that the man who was supposed to be socialist, giving out free power, free water, whatever it is, would come up with an exemplary excise policy? Now, if that is followed by every state or state capital, the industry itself would just go into different stratosphere at the end of the day. And we're talking of consumption, we're talking of people going out and spending money. Liquor is only going to be a side element. Nobody goes just drinks. People eat, people have, other stuff as well. So, if you look at the excise policy of Delhi, which came out yesterday, I think it's a landmark regulatory policy in the history of India, which breaks all taboos and says consumption is good, enjoyment is good, frugality is okay, but that doesn't help the economy.
Can you tell a bit about that, Ajay? And then we'll wade on to other matters. Why do you say that it is such a landmark thing?
I tell you, first landmark it says is that government has no business to be in the liquor policy, which is liquor business, which is amazing because that's what holds up the liquor business. If any of you have traveled to Uttarakhand, you will understand what I mean. You cannot get any decent liquor in Uttarakhand. Everybody carries from Delhi, and the hotels are losing revenues. You go to the wine shop, you get some brand which you've not known of. You cannot get anything of worth because Uttarakhand government says we will control what comes into Uttarakhand. So what is the end of the day? Customer loses, restaurants loses, hotel loses, people take from Delhi and you consume there. So that's just to give you comparison. And this policy says, first preamble, government has no business to be in liquor supply or distribution at all. Its only job is to regulate and collect revenues. Number 3 is consumer is king. We will give you outlets spread over across the country with the standard minimum consumer expectation being fulfilled. It's not those outlets in like Haryana that you see vents on the road. It's going to be air conditioned. You got to be nothing will be sold outside. Premium shops will sell a liquor only above a certain rate. So if you're a good, well-heeled customer, if you're a woman who buys good, expensive liquor, you can safely go to the store and expect a good collection. And it says you will have to stock minimum of 50 brands of premium liquor. So you can't just buy what you like, 2 brands, and deal with the manufacturer. you got to stock 50 brands. Now, that's something which is amazing policy to my mind. Copy it everywhere. India looks a different destination. And catch it with that Indian Delhi restaurants can serve till 3 a.m. You got a vibrant nightlife coming in as well.
Well, imagine Rajasthan. Goa, of course, must be doing this, but if Rajasthan and Kerala follow suit, then wow, the tourism hubs really get a big boost. But nevertheless, so let's talk about then, therefore, Ajay, the more, the lowest common denominator matters, if you will. Yeah. And I have 2 or 3 points which I wanted to talk to you about, which is what I said in my preamble as well before we started talking. I heard you mention that the market is giving you a chance to buy companies which you thought you wanted to buy, but you could not buy. Now, would commodities form a part of this bucket? Then, of course, I'll ask you about where do you think what forms a part of this bucket. But my first question to you is, would commodities be a part of this? Because I'll tell you where, Ajay, I see most people confused, and I would love you to give me a sense here. Most people are believing that they want to follow the price moves of the underlying commodity into the stocks. And most brokerage notes that are coming out are saying that even if the prices were to move down a little bit, the way the prices have gone up and the new normal will ensure that these companies have great profitability, lower leverage, and therefore superb earnings. Now, how would you dissect this piece for us?
See, first of all, everybody gets scared when they look at the prices of these stocks to say, these have gone up 4 to 5 times, right? That's the first, everybody looks at saying, oh my God, it's already gone up 5 times, what's left to be done in the stock? So you get scared. So there is and the natural phenomenon is that these prices, after going up, have been consolidating for the last month and 2. If you look at it last month and 2, the commodity stocks, steel stocks, whether it's Vedanta or anybody, has given almost 0 returns to the investors, just like what happened to the banking sector, it didn't give any returns. So right now, if you look at the sector, you'll say, 1, prices have gone up too much. Number 2, the sector hasn't moved anywhere. The index has gone up to some extent, not too very much, but still this sector has not moved anywhere. Number 3 is, so is it over? And everywhere the same noise comes out, the commodity prices are peaking, China will bring it down, and Russia has flooded the steel market, etc., etc. Too many dissonance. The key thing is that what's happening around the world, and that's the cue. The cue is that US is going to undertake the greatest infrastructure buildup in the history since the Second World War. That's an honest fact, right? India has no choice but to do it at this point of time. There is no choice for the government if he has to plow the money. So is the rest of the world. It's not that Europe is going to sit outside the infrastructure boom, and so is the Middle East. You saw the Saudis coming and saying we want to do airports, and the construction in Dubai, if anybody's been there of late, has just gone back to the straight old levels. So the core level is that these companies, which went through a big round of leveraging and growth and struggle and prices and losses, have now for the first time reached free cash flows, deleveraging, steadied expansion. They're not going to hell and heaven and water. And the most important part is that the balance sheet is looking a lot better. Most of the leverage is now down to 2 or less, EBITDA down to less, and so on. And the best part, the Indian banks now want to lend to them. 3 years back, nobody wanted to lend to them. Banks wanted the money back. Today, I'm told that when the banks, these people are going and saying, want to return the money back, they're reducing the interest rate and saying, keep the loan for God's sake. So the paradigm of these companies has changed. The balance sheet has changed. And I think most analysts have got it wrong that these are expensive stocks. None of the stocks are over a multiple of 4 or 5. At the end of the day, P, multiple of 4 or 5. And with an EBITDA multiple, which is, of course, just next to nothing. Deleverage balance sheet. So if you have lost out, if you have not bought it, please go ahead. And my recommendation is that I've got invested in these stocks, so I've got a vested interest, but I'm not saying stock X or Y or Z. As a sector, you will never get a chance to get it again in this sector for the next 5 years, because the next 5 years is going to be the golden time. Cycles don't die. New factories don't come up overnight. You can't put a steel factory overnight. And you've seen the struggle of NMDC trying to set up a steel plant. I know they've announced some 6 commissioning already, right? And then they go and sell the shares cheap. So anyway, leave that bizarre. So you will have bizarre management decisions affecting your prospects. I can't discount stupidity in the market and management, like NMDC divestment. There's a gross stupidity, like PNB housing was a disaster, right? Now, I can't discount that. That can happen to you as a dear investor. But by and large, you will be on a very safe and steady ground if you are in these stocks. and you'll get good dividend as well. So do not worry, do not hesitate. Left out, go ahead, buy and hold.
Would the same argument hold for upstream as well? No new capacities have come on stream. If OPEC Plus is any indication, oil prices are probably headed higher. So it's a very tightly controlled cartel. Are you building any hypothesis here?
See, unfortunately in India, there are only two stocks to play the oil story. It's either ONGC or Vedanta. Vedanta is part oil, part commodities, and ONGC. Now, ONGC's history of performance, I'm sorry to say, is a disaster. Absolute disaster. At the best of time, it never makes money. At the worst of time, it loses money. Can you believe that guy still doesn't, whatever cash he accumulated, he was made to spend on HPCL purchase. So I can't blame him also to that extent. But the fact is that the gross production of ONGC has been steady or falling in the last decade almost, right? They haven't done anything about it except taking back their salaries. So, so unfortunately in India, the oil game, you cannot play at the source level at this point of time, because you can either buy Vedanta or you can buy ONGC. ONGC has been, it's like NTPC. The worst two dogs in the market have been ONGC and NTPC, and I don't know what can change them.
Got it. Ajay, just before I ask you the broader question about how do you think to play this, just wondering, since we're on the topic of commodities, did I see the Dimensions name into a few soft commodity stocks, sugar and some of the others, or am I mistaken?
No. Yes, we have investments in, certainly we have investments in sugar industry at this point of time. It's been there for a while. It's not been a recent investment. It's been there for a while. And it did better because of the government announcement on ethanol, nothing to do with sugar. And as much as I said, sometimes you believe that you're doing the wrong thing. Ecologically, it's the worst thing to put sugarcane in this country where there's no water. But well, what can I do? If the government gives me a bonanza, I need to take it. So answer is yes, we are invested in it. And as always, these stocks went up quite substantially, went up the second leg after the government ethanol announcement, the second announcement which came in. Now we'll consolidate for a while. So you will have time to get in. So as I said, market will give you time to get in again into the stocks.
Okay. So then, Ajay, let me ask you then the broader question. I actually pumped you with a few of my queries about themes that I thought fit that bill. What do you think fits the bill right now? About in businesses wherein, if not now, then if there is a corrective move, or even if now, the market is giving you the opportunity in a long cycle, in a cycle which is there for the next few years, but you're getting an opportunity right now. What is it?
See, it's, again, it's not something which is a remedy for a solution for everybody. But we believe strongly that at the end of the day, you need to bring in stocks into your portfolio which have given double-digit returns over the years. And there are at least 20-30 companies in India which have given double-digit returns year on year. So whether you look at Asian Paints, you look at Pidilite, or you look at so these kind of stocks are your core of your portfolio, and therefore you can you build your core portfolio. Then is a transient, which is a commodities, which is a little more higher risk, and then you go to the seriously risky one, which is the small cap, which is sectoral plays like sugar. We have a large holding now in paper industry at this point of time, and paper is doing reasonably well. And I think when the economy opens up, schools and all open up, the pent-up demand will be astronomical. And and so you got to pick up industries where now there are, except telecom, which for reasons we'll discuss later, wherever there are now duopolies in every industry, or at least not more than 3 people, now you're finding serious returns for the shareholders. So if you look at the Pidilite, it merged this thing, Fevicol, and therefore it's got a higher speed returns. If you look at paper industry, now there are basically 2 people left in this country, by and large, JK and Wesco. So, they're making supernormal profits. Whether it's a consumer space, you've seen what's happening to Dabur and Emami in the rural space, phenomenal, Godrej in overseas. So I think you need to focus on the guys which are giving you double-digit returns at this time, because they're the ones who are going to go forward and give you returns at the end of the day. If you're going to experiment too much at the portfolio at this point of time, you could come to grief at the, given what the market dynamics are.
But you comfortable buying these staples and consumer names at 65, 70, 75 PE multiples as well?
From the time I started investing, I have never found Asian Paint cheap.
Yeah, but then it was 35 times. Now it is 75 times.
As I always say, that who am I to argue with the market? Okay, I will not be stupid. I will not go buy hundreds of Asian Paints and borrow money and borrow Asian Paints. But if not to hold that in the portfolio, where now we are seeing the first big home building coming up in the industry. You saw the inventory coming down and new construction is reaching its peak. At the end of the day, rural India, hopefully at some point of time, will start to kick back again. So these are names with embedded stuff. And you're talking about 60 PE, right? I was talking to somebody interesting to say that I'm going to be actually investing in a stock called Zomato, which has got a minus 30 PE, right? It's got a loss of 2,500 crore, valuation of 28,000 crore, so minus 10, 12 P, 15 P. Now, at least it's plus, for God's sake, right? Now we're discussing investing minus PE stocks.
Yeah, and that's coming up in a big way, right? I hear that the demand for Zomato from the global guys is pretty strong. And I don't know, Ajay, if this whole thing of what China is doing with Jack Ma or what they did with Jack Ma or now with Didi, etc., also feeds into that global appetite, because maybe some people might think that do they want to take the China risk in some of these pockets versus maybe India, wherein the sector seems to be now coming up, right? We've had a gaming company, we have this, then we'll have what you called the mother of all IPOs in the last conversation, Dream 11, if I'm not wrong.
Yeah.
Right? So we'll have all of these companies come up.
Yeah, so that's why I said you're talking of positive PEs, for God's sake. That's some saving grace, right? You saw the money made in Amazon. It didn't make money for like donkey years. I know. On a more serious note, I think that we are actually paying for franchise value. And I keep saying that market will give you time to when the market corrects. It did correct, like March 20 was an opportunity. July, up to July was an opportunity. I'm sure you will get some more opportunities down the line to maybe buy them at cheaper stock. But to stay out for all times also is not the wise strategy at the end of the day, to my mind. And the last part is, the beauty of these stocks is that even if the worst sell down happens, there are not many people who liquidate these stocks unless margin calls happen. Nobody goes and liquidates this stock for profit booking, unless your broker forces you to sell it, because what happened in March at the end of the day, stocks were sold, all right? So to some extent, it's a safety. It's a good thing for your family. It's a good thing for your future planning. And, you're right. China, with all what they're doing, is not going to be good for their stock. But even in India, we'll have come to the point we'll have to review what's happening, because if you look at the education sector, China has done a smart thing, gone back and said, we got to limit education, Edtech sector, because what are we doing to our children? They go to school for 8 hours and then they come and do online classes and this classes and that classes. Everybody's telling them you can get in. So what have we done? There is no control in India, licensing of education sector, tech sector. What they're selling to our children, nobody knows. Is it value addition? Nobody knows. And what are you asking a child? Come back from school instead of going, playing, doing something. And you start to now download Byju's or download X, Y, upgrad, YGrad, and sit at home in this computer. Now, I don't believe that India will remain unregulated. I think just the way the e-com debate has started, we will also have the debates of that when the Swiggy, Zomatos, Edtech, etc. are going to be this thing. We'll also have a debate on fintech, how they're encouraging people to borrow money and putting them into trouble. I have started now getting 150,000 loans, etc., etc. So I told my wife, what? We have been downgraded. We have just been allowed to. After all these years of working, this guy says I am only qualified for 150,000 loan.
Yeah, that's money on tap, right?
you know what I mean. So I think we will also see regulation in the sector, Neeraj. But I think for the time being, I think these IPOs will get a good traction. We are starved of such stocks in this country, and so there is a scarcity element as well.
That's true. Ajay, speaking of margins, do you have a thought on this margin rules? You were referring to that yesterday about how it's hurting the market momentum.
See, what we have done to our margin. At the end of the day, now you're almost providing 100% margin for anything through the day. Now that actually violates the whole concept of futures and options trading, because the whole idea is to use leverage to multiply your exposure to the market at the end of the day. Number one, you started by making lots bigger and bigger. Look at America, what they've done. You can buy fractional shares. If you can't afford $2,500 of Google, you can buy 1/10 of Google or a Bitcoin. Now, India is doing exactly the opposite, and I have a reasoning for that. And I think what India is trying to do is, there is whether it's backed by industry player or it is policy decision to herd the people into mutual funds. it got broken now in the pandemic thanks to Zerodha and ICICI Securities, etc. the world. So people started investing directly. But I think there is a concerted attempt at the policy level, at the level which banks control, and that's how the banks work, that let's put everybody, try to get him into the mutual fund. Let's make it so difficult for the investor to do it that he can't do anything on his own, goes to mutual fund. And that's stupid because your volumes are falling in the market, liquidity is falling in the market, you're not helping anybody at the end of the day, retail participation is going down in the market. So world is moving to fractional shares. We are moving to a 10 to 20 lakh lots, 100% margin. And if you look at a bank nifty, buying one bank nifty today, lot, eats up all your margin. So while earlier bank nifty was the most vibrant product to be used, and it was very widely participated in retail. But given the margin today, Neeraj, what returns can you make on a bank nifty? So you give up bank nifty trading. Now, how is that helping anybody? I do not know, except helping the mutual fund guys saying, "Yaar, nahi kar sakte hain, chalo isko bank mutual fund mein dal dete hain, khatam karte hain." So, but I think it's counterproductive. It's not the way the world is going, and someone needs to look at this margin thing. And why are we worried about people losing money? People haven't lost money in mid cap, small cap, a Jet Airways stock, and kind of stocks. People have lost money. We don't ban trading in Jet Airways when people know your stock is going to become 1 rupee next morning, and people are still buying. I was another program on that day, and I'm asking Lata, your colleague in the other channel, so why is anybody buying Jet Airways? She says, search me. I don't know why anybody buying Jet Airways, because it's going to get 1 share out of 100. But people are buying till the next year trading got stopped. But so I think you cannot sit in and start to say, I will manage risk for people. What you got to have, the margin mechanisms should be robust, but not what this will become today. So is it going to hurt us in the end on liquidity side? It's going to hurt retail investors. So my request is, if you can, world is moving to fractional shares. Let us allow private investors to take a part of the capital market. Let's not herald them into, mutual funds. I have an issue with them. Leave aside this 1 year. They haven't performed for last 10 years. Just take this 1 year out of the picture and you see the performance. Pathetic. So why are you letting people go the same path? And 2.6%, expense ratios. Who in the world today pays 2.6% to manage your money? I think it's incredibly greedy of these companies. And then the policy decision is, let's go invest more. And that's why I like some ETFs coming up, but it's not volume good enough. 2.6% is loot in this world today.
Yeah, and so the only playing the devil's advocate a little bit, there are probably a few very high quality funds which are actually done well, and maybe if you link it to performance, maybe some expense ratios might still be acceptable. But which is why, Ajay, I feel that some of the disruptions that are coming in the AMC space, notably from the name that you mentioned, Zerodha or some of the others, might be actually a pretty interesting thing. In fact, I see some of the mutual fund houses as well now come up with very low expense product, direct investing products or fund products, which is probably the way to go. But be that as it may. But yeah, the point is well taken. I think when the world is moving towards fractional investing and making it as convenient as easy, instead of trying to decide themselves what is good for the retail investor, we kind of moving in the opposite direction, which is probably not healthy. Speaking of which, since we were talking about banks, any thoughts on how the financials do over the course of the next 12 to 24 months?
I was telling, again, the same program, telling Lata that for the first time in my history of investing, I actually have 0 banks in the portfolio. It's amazing. It's never happened. But now, and this has been for a while now, because for one reason, I thought the returns are going to be marginal, because if your volume of business is not growing, how long can RBI repo rate keep you floating? If you look at India's bane is RBI's repo rate. Why can't repo rate be 0? Tell the bank, if you got surplus money, you keep it in cash in the RBI and you'll get 0 return, force them to borrow. You are today getting money from current account and CASA, which is sub 3% money, happily putting money in the repo, lakhs of crores goes every day in the repo. Why does the bank need to lend anybody? So when we looked at in the month of March, we looked at what banks were doing and the volume of loans, we came to the conclusion that the core business of the banks, which is loans, at the end of Indian banks at least, Forex and all revenue will go up, other income, but banks and the loan sector will go down. And the kind of competition which will come from fintech will be phenomenally higher at the end of the day. Housing finance, there used to be 1 or 2, 3 people in the LIC, HDFC, etc. Now I think last count there were 20 people competing for the same pie. I know. So in a market where there is volumes are low, 20 people competing, 200 fintechs already trying to lend money, we just thought it's not a paradigm where you get superior returns compared to rest of the market. So our view is that the cyclical play, and it's played out well, would give a better return, including the next 6-9 months, than the banks. And now with the yield going to 6.2, I don't know what it will do to their treasury portfolio. How much is in mark-to-market portfolio at the end of the day, and how much is in HTM. But it's certainly affecting the profitability if the yield starts to go up now at 6.18 yesterday. If it goes up, that knocks a fair bit of dent in the balance sheet of the company. So banks, I don't think, are going to give superior return than most real sectors of the economy. And I think I just blame RBI for it, that take away the repo rate. Force the banks to do what they're supposed to do. Like you're producing programs. If someone tells you, Neeraj, sit at home, watch Euros, go to sleep, and I'll give you a check in the morning. Well, Neeraj Shah will say wonderfully, I'll watch more tennis and more football. So banks have now stopped the business of lending. And I think it showed up clearly in what happened in Citibank. They had to sell Indian franchise. This is what happens to banks which lose the core franchise and the core business to work. They will be sold out. But, so banks, no, not give you better return than the rest of the market.
Financials, the NBFCs?
Oh, gosh. Now, there we go. You're talking about 60, 70 Ps with no growth. What do you think of Bajaj Finance comes one morning and says, I'm a fintech. I'm not an NBFC. I'm a fintech. And the market says, wow, you are a fintech. Next morning, you're born a fintech. So the price goes up by 25%. I do not know what to say. I don't have it. I do not know what to say when a company with growth 4-5% has a P of 60-70% in a competitive market. It's a phenomenal company. I have always been amazed at the valuation it commands, to be honest and fair. It's given very good returns to shareholders, but I don't have the stock. I'm neither a buyer of the stock. I'm more a buyer on the side, which I told you was the side which are intermediating on the capital market side. The brokerages, some of the stuff, those have given us better returns, and we still remain focused on that, because if they keep doing what they're doing, I think they will give much better return than even NBFCs, and with no risk. NBFCs still run the risk. These brokerages don't run the risk. Look at what happened to ICICI Securities, look at Motilal Oswal, look at what happened to the other brokerages, online brokerages. They're doing so well with low risk. So superior returns there. It's all about allocating capital needed. Not saying that Bajaj Finance will not go up, but I think, risk to return ratio perhaps would be skewed towards service companies than for the funding companies.
Before we wrap up, Ajay, what is your view on IT services? We start the earnings season from tomorrow. Mid-cap IT companies are by and large, I just wrote a piece on the mid-cap IT companies and the kind of valuations that they're trading at, which maybe the market believes that they will continue this 15-20% growth for the next few years. What's your sense here?
See, these are good companies. The best part is these are safely governed, by and large, good companies. Large IT, small IT, whatever it is, are good companies. That's one thing that you want in the investor. Number two is all of them reward you. Whether it is buybacks, dividend, etc. They keep rewarding you and keeping the pipeline. They don't go. They are not ITC. Okay, which somebody my memes that say that's part of the furniture. Somebody says a 200 rupee note, which will remain 200 20 years down the line as well. So these are not ITC. They don't go put money anywhere. They give it back to the shareholders. Their core franchise is expanding. There's a lot of investor interest in it, but you got to be patient with this stocks. Very rarely you'll find them flying up, and they will again offer correction. Let's say Infosys. Just now it went back to 1420, 1430, has now come back to 1580 across the new high. So this is a sector where you got to patiently keep investing and just holding the stocks, and every correction buy in, and do not worry about right now, because the demand side is phenomenal at the end of the day. It's not, and today they're only doing America. The rest of the world still has to catch up with digitization, including India. And when you spoke about banks, I forgot. The biggest risk in India and the banks is what HDFC Bank has shown is the poor investment in technology. It's a highest risk venture. So I think IT companies stay stable investment, but you have to keep adding on to it. When a correction, don't sell out, don't sit through the correction, buy it. The reason mid-cap are more expensive, one of the reasons is that there is a ready market for buying out of these companies. Unfortunately, there was like Emphasis could not be sold, so another fund of Blackstone bought it out. But look at the share price at 1480 or not. The deal went to the market, and today it's about $1,800 or thereabouts, if I'm not wrong. So therefore, I think it's stable, good stocks. It's not excitable. If you want gamble, go to Vegas. It's open. So these are for the absolutely the opposite of Vegas excitement.
Okay, point well taken. Lovely conversation, Ajay. Thank you so much, and stay safe.
You have a good time as well. Thank you.
Thank you. And viewers, thanks for tuning in to this edition of The Talking Point.